All right, good morning, guys. You guys should be getting this sometime tomorrow, hopefully. It'll be Tuesday, the very start of our first real lecture. I want to start off by going over a couple things with you guys individually. Now, this is managerial accounting. Obviously, you all took financial accounting prior to enrolling in this course, and you had to have gotten a certain grade in financial. So, the first thing I want to start off with you is just to, number one, ask you to open up your Vanco Hall and click on the managerial accounting class that you're in. Open up chapter 10, which would be under topic 1. Open up the slides for chapter 10. And I just want you to leave them in front of you real quickly. What you're going to be doing is you're going to be listening to my voice as I'm going to be pretending to lecture as if you were sitting in front of me. And we're going to go slide by slide the same way I would as if you were in class. Prior to starting chapter 10, I just want to go over some things. Now, like I just got done saying to you, you had to have finished financial accounting to be in managerial. So with that in mind, I just want to go over a couple topics with you prior to starting chapter 10. First thing I want to talk about is, at this point, everybody should know your different classifications, meaning your Al's Dre for those of you that had myself, or for those of you that had Mrs. Clifford. For those of you that may have had Mrs. Hike, she may not have used the acronym Al's Dre, but some of you guys, I hope that it's pinging in your head. Al's Dre stands for assets, liabilities, stockholders' equity, dividends, and retained earnings, and dividends, revenue, and expenses. Now, keep in mind, the stockholders' equity does break up into two parts, which for all intents and purposes in this class, we're going to call that contributed capital or common stock. And the other half of stockholders' equity is going to be your retained earnings. So please make sure that you understand what ALSTRA stands for. That's assets, liabilities, stockholders' equity, dividends, revenue, and expenses. Another thing I want you guys to think back to financial is the 3 financial statements that you should have learned and prepared in financial. Keep in mind a couple key points that I want you may want to jot these down just so that you keep them in your memory and close to your head, is the order and preparation of those. Now, if you had Clifford or myself, you would know that you go from the bottom up, meaning you start with your income statement, then you move on to your statement of retained earnings, and then last but not least, you go ahead and you prepare your balance sheet. Now, a couple key things that I want you to pay attention to. On your income statement, the types of accounts that you find on there will be just your revenue and your expenses. And at the very bottom of that, you come out to either a net income or a net loss. Whatever that number is on that income statement, you should remember gets brought up into your statement of retained earnings. Now, the statement of retained earnings has your dividends and your net income or net loss brought up to it, which will then give you your final or your updated stockholders' equity part called retained earnings. That amount gets transferred to your balance sheet. So I want you guys to just keep in mind and just remember the correlations, the order in which you have to prepare them, which is your income statement, statement of retained earnings, and lastly but not least, your balance sheet. Another thing to keep in mind when it comes to financial statements, your balance sheet has an equation that we go by with that. And there's what we call the accounting equation. And that is simply that your assets must equal your liabilities plus your stockholders' equity. So the balance sheet must balance when you're finished preparing it. Another thing that I want you to keep in mind is that one of those 3 statements has a different date, meaning it is not for a period of time, but is for a specific date. So if you can think back or look back at any examples that you might have had, you would notice that your income statement and your statement of retained earnings are for a period of time, whether it's 1 year, if it's for a quarter, it could be for a month, but your balance sheet date is actually for a specific date, meaning December 31st, 2020. It's not for the year ending. It is exactly for that date, December 31st, 2020. So just some characteristics of your financial statements. I want you to think back, and if it doesn't sound familiar to you, think back and look back into some of your notes that you may have left from financial. A couple other points I want to click on or point out is, how do we know if something is a debit or a credit? How do we know what balance a account carries? So for that, you should have learned the acronyms ADE and the LSR. The ADE stands for assets, dividends, and expenses, and they all carry normal debit balance. Meanwhile, you will have your liabilities, stockholders' equity, and revenue, which are your losers, and they have a credit balance. Okay, so please keep in mind those types of scenarios that I want you to pay attention to, that we are going to be going back to those principles quite a bit as we move along here in chapter 10. So those are just some of the minor points that I want you to kind of think back to financial. Again, this is a sequential course, meaning you had to have done financial to be in managerial. So please keep that in your mind when we're going through this. This is stuff that you have learned. Now we're just going to go through and apply a little bit more to it. All right. So with that being said, I just wanted to recap some of the things that I wanted you to know or think back to in financial. And now we're going to get into the stuff that we actually need to do for our course. So it's beginning in chapter 10. We're going to talk about the first thing you see there when you open up your slides. First slide says chapter 10, long-term liabilities. Well, just taking a look at that, I want you to pay attention to the words long-term liabilities. Well, that should automatically in your head say to you that a long-term liability is something that is going to be longer than 1 year. Okay? So accounts payable is not a long-term liability. Accounts payable would be a short-term or a current liability. So all we're going to be dealing with is liabilities that are for multi-years, meaning a 1 year or longer. It could be a 5 year, it could be a mortgage like a 30-year, things like that. So these are all things that are going to be long-term. So flip to number 2, slide number 2, and you'll see the first slide, and getting started now. So the second slide, as it is, says, how do corporations get money? Okay. Now, every corporation needs money to continue operations. The whole purpose of being in business is to make money. So one of the things that we want to look at is, where do corporations actually get their money to stay in business? So the first bullet that you see there, it says cash flow from operations. And in parentheses, it says everyday operations. That is very simple, okay? If you take a look at McDonald's down in the Price Chopper Plaza, they're making money every day because of the fact that people are going there and eating every day. Okay? If you drive down there at a lunchtime, at noon, you'll see that their line for the drive-through is practically going all the way down in front of Ace and blocking part of the parking lot. Okay? So them actually effectively doing business all day is what we consider everyday operations. Okay? Price Chopper, they're open from 6 o'clock in the morning till 10 o'clock at night every day. So they're supporting their business by doing what they're in business to do, which is sell their product and make money doing it. So that's one of the first ways that a corporation accumulates cash for whatever purpose they're going to be using it for. We're not concerned with what they're using it for. We're just concerned with how are they getting that money at this point. Okay? The second one there talks about sale of stock. Okay? Now, you guys all have heard of the stock market. You guys all have heard about, the high-flying stocks of Apple and Amazon and Alphabet and all these other, Facebook and such. Okay? Companies sell their stock to raise money. That money that they receive for their stock is what they use to do things with, whether it's open up new restaurants or update their supply chains. They research and development of new products. All that money that they raise can be used for several different things. Again, we're just concerned with where are they getting the money from. So the second way that corporations get cash is that they sell their stock. Now, we're going to be talking about stock, or what we call equity, in Chapter 11. So that's going to be our next topic when we get into Chapter 11. That will be our next topic that we tackle. The third and the fourth way really go hand in hand, because really loans and bonds are pretty closely associated. A bank loan is simply when you go into a bank and you ask for a loan. Okay. Some of you guys in your lifetime have gone in and asked for a car loan. Well, same type of scenario happens here. Businesses can go into a bank and ask for money, and they get approved and denied the same way you and I would if we walk into a bank and ask for money. Companies do it all the time, and some it works for, some it doesn't work for. The last thing that a company can do, or companies do, is they do what they call a sale of a bond. Now, this topic is what all of Chapter 10 is about. You're going to hear the word bonds for the next 2.5 weeks. You're going to be so sick and tired of hearing the word bonds. All right? Bonds are simply a liability, meaning I'm going to borrow $1 million from you, and I'm going to hand you a piece of paper that says, I owe you $1 million. It is in essence what that is. Okay? A bond is a piece of paper. The person who lent you the money is now a creditor. So they are paid first in liquidation. And what a bond is simply just a piece of paper saying that you borrowed money from them and that you are going to pay it back. Okay? So just think of bonds as it's pretty much a bank loan, but it is through a private investor. The difference between a bank loan and a bond is bank loans come from a bank, and the sale of bonds or bonds come from investors. All right. Now, like I said, we're going to be talking about bonds quite a bit. So let's just jump right in on slide number 3. And you'll see that the title of slide number 3 says the word bonds. Now, these are some key characteristics about bonds that I want you to know. Okay. I will ask you on your first exam, when that time comes, characteristics of bonds. And I will tell you exactly what I'm looking for. So all you really need to do is pay attention, put a little star next to it if you printed your things out, make a little note sheet of, hey, Mr. Vandermark said, or Brian said, this is probably going to be a test question. Well, write it down on a piece of paper that's labeled test questions. For those of you that have never heard of me or never heard it or spoken to anybody that's taken a course with me, straightforward. I tell you what's going to be on the exam, and that's what's going to be on your exam. I don't like throwing curveballs. I don't do any of that. So if I tell you to know something, know it. One good thing about this class, just to give you a little tip on the inside, our exams are not cumulative. Okay, so our first exam would be chapters 10 and 11. It's not going to be 10, 11, 12, 13. No, your final exam will only be on your final exam chapters. It will not be on the entire course. So what you need to pay attention to is pay attention to the chapters we're working on for your exams and worry about them. Okay? All right, back to the topic. Bonds. First thing you saw in the very first slide was that we were talking about long-term liabilities. So the first part of the definition of a bond, it says bonds are long-term borrowing. Okay? The next part of that is that it says it has periodic interest payments. Okay. Now, the key with interest is, does anybody have an idea of what they call interest, or what's the definition of interest? Well, my definition of interest is it's the cost to borrow money. Okay. If you go out and buy a car with money from the bank, you're not only paying your car loan back or the principal, you're paying interest. That's how banks make money. Okay. If you go and borrow money, they're going to charge you a certain percentage. Well, that percentage is how the bank will become profitable. Okay. Now, as you can see here, the next part of slide number 3 says the only difference between a bank loan and a bond is who's giving the money to the corporation. Bank loans come from a bank, while bonds are sold to investors. Okay? So what I want you to get out of this slide is bonds, long term, and you're to pay periodic interest payments. Okay, that's going to be what we call the cost of borrowing money. Moving on to slide number 4. Now, not every one of these topics that are in bold I want you to know, but I will tell you the ones that are important to us and what we're going to be worried about. The other ones, just kind of put a little X next to them or cross them off, or don't do anything with them and just write down the ones that are important. Whatever's best for you. So, key aspects of bonds. Now, first one, it says face value. The value of a bond that is pre-printed on the bond certificate. The easiest way to think about this, pretend you've got a $50 bill in front of you. That $50 bill has a certain amount that's printed on there saying it's worth how much? That $50 bill is worth $50. That is what we call the face value. Now, it could be worth 100 in certain times, but for all intents and purposes, the amount that's written on there is what we call the face value. The face value of a $5 bill is $5. Face value of 100 is 100, and so on and so forth. Okay? So face value is one topic or one aspect or characteristic of a bond I want you to pay attention to. The next one, I want you to skip over the interest rates for now, and I want you to go into the issue price. Okay? The issue price talks about the amount that the bond is actually sold to an investor for. And it says that it is frequently different than the face value. Now, what this means, take that $50 bill that I just was talking about. The face value of that $50 bill is $50. But for some reason, John Doe is willing to pay me $70 for that $50 bill. Okay, so if I accept $70 for that $50 bill, my issue price is actually $70. My face value of the bill was $50, but my issue price was $70. Okay, that's what it means by issue price. Now, if that same $50 bill, I couldn't give it away, I couldn't sell it at all, and then I finally get somebody who's willing to pay $40 for it, the face value still stays the same at 50, but my issue price has now gone to 40. Okay? So the issue price is the amount that the bond is actually sold to the investor for. The face value is what you see pre-printed on what we call the bond certificate. Okay? Just move on to your next slide, which is slide number 5. Next one. This first characteristic that you see under slide number 5, it says bond indenture. This is my favorite test question for your first exam. It's not worth a whole lot of points, so don't go crazy like, writing everything down. But this is a question that you will find on your exam no matter what. It's been on my exam for the past 7 years that I've been doing this, and it's not going to stop now. So the bond indenture, this is the contract that you sign or that you are entering into when you sell a bond with your investor. This contract has all the information that you'd want to know as an investor. Okay? First thing, it talks about your maturity date. The maturity date is the day. So let's say I borrow $1 million and I'm going to pay you back in 3 years. The maturity date is what date in 3 years that I'm going to pay you back. Okay, so that may say I am going to pay you back December 31st of 2023. The day I'm going to pay that money back, that's what we consider is our maturity date. Okay. The next thing is what dates we're actually going to pay interest. Now, this is important to investors. You probably will not be able to borrow money as a corporation if you're not willing to pay for it. And those payments, as we said before, are what we call our interest payments. Now, one thing I want to point out to you in this class, interest payments are going to be paid twice a year. Okay? So keep that in mind when we start talking about interest here in a few minutes. Interest is always paid twice a year. It's going to be paid January 1st, and we're going to call it July 1st. Okay? So interest payments are going to be paid twice a year. The bond indenture lists those dates. The other thing that it does is it tells you what interest rate the investor is going to be earning, which is the same rate that you're going to be paying. So the bond indenture is very important. That gives you all the information about the bond that you're selling. Now, one example I want to make is if you are out there having to sell a bond, meaning you need to raise money, you want to pay a low or a high interest rate. Just think about that for a minute. You're going to be paying an interest payment. Do you want to pay a high rate or do you want to pay a low rate? So to answer that question, as a borrower or somebody who is selling the bond, you want to pay the lowest rate possible. Does everybody understand that? If you don't understand that, let's think about it this way. If you were to go out and purchase a new car and you took a loan out, do you want to pay 10% interest or do you want to pay 3%? Hopefully you're still thinking that you want to pay 3%. Okay? So the key here is that as a company looking to sell a bond, you want to pay the lowest interest rate possible. The key here with the bond indenture is I just want you to understand that this is a contract. This contract is very important to investors because this tells you what you're getting yourself into. Okay? No investor should be loaning out money without knowing key aspects, such as when am I going to get paid back? How much money am I going to make? If you were the person loaning the money and I'm willing to pay you 7%, and the teacher in the next room is only willing to pay you 3%, which one are you going to make more money off of? Well, if you're the one loaning the money, you want to make the highest interest rate. So put yourself in the shoe of the person you're thinking about. As a borrower, you'll want to pay the lowest interest rate. As the investor, you're going to want to get paid the most, the highest interest rate as possible. So just keep that in mind. Now, as far as bond indenture being a test question, I say this all the time and I accept this every time. There's a one-word answer that you can answer my question for. Your question is going to say, what is a bond indenture? That's your test question. I'm telling you on the what would have been our second day of class, a 3-point test question. What is a bond indenture? And your answer could be what? 2, 4, 6, 8 letters or one word. And all you have to write down for me is contract, the word contract. The bond indenture is the contract that gives all the information about the bond that an investor would want to know. I simply accept the one-word answer of contract. In 7 years of teaching this class and 7 years of giving that question on an exam, I have not had one single class, not one, have everybody in the classroom get that question right. Hopefully you guys prove me wrong. Obviously with the COVID thing and everything being different, I hope so, because you'll have time to be able to do certain things that other students weren't able to do. But the one-word answer for bond indenture is the word contract. Okay? Moving on. The next one talks about bond issue. The bond issue definition is the total value of the bonds issued at once. So let's go this route. I am going to issue 100 $5 bonds. So I'm going to issue 100 individual $5 bonds. So how would you go about figuring out your total bond issue? Well, you're going to take the number of bonds, which I just said was 100, times the value of each bond, which is $5. 5 times 100 equals 500. So the $500 would be your total bond issue. Okay, that's the total value of the bonds issued at that particular time. My next test question comes up right here, and we talk about secured versus unsecured. Now, there's a one-word answer for this also, and I'm going to tell you that word before I even go into the definition. The answer to the question when I ask you what's the difference between a secured and an unsecured bond, the one-word answer is collateral. Okay, collateral. Now, if you read what the definition says, unsecured bonds are backed by the faith of the corporation. Secured bonds are backed by some type of collateral. So let's give you some examples of that to drive this point home to you. When you go out and you buy a new car, okay, the bank pays for your car and you pay the bank every month your car payment. If you do not make your car payment, eventually, after you've missed enough payments, the bank is going to come and do what? Hopefully you guys say to yourself, they're going to repo my car. Okay? What they're doing is they're repossessing the collateral. If you do not pay your car loan, they're going to take the car back. Okay? If you take a mortgage out and you don't pay your mortgage, they're eventually going to foreclose on your house, which means at some point, if you haven't paid your mortgage, they're going to kick you out of your house. And after they kick you out of the house, they're going to sell your house to get their money back. Okay? So the word collateral means putting something of value up in case you do not pay. So the best example is your car loan. Okay? They take a lien out on your car. So if you don't pay your car loan, they're going to come take your car away and they're going to sell it and get their money back. An unsecured bond is literally like borrowing $10 from your roommate. Okay? You don't ask your roommate for collateral. You just tell your roommate, hey, give it to me whenever you get it. Or give it to me when we get to Farrell to the ATM. Okay? You're taking the faith in that person that they're going to pay you back. The same type of thing that corporations do. Now, one thing I want you to think about when it comes to secured and unsecured, I know the answer is collateral, blah, blah, blah. The older the company, the more established the company, the more likely they are to have unsecured loans. And what I mean by that are companies that have been around forever. Coca-Cola, Ford, even Apple at this point. Those are companies that they don't really feel as a credit risk. They don't feel like they're going to lose if they borrow their money. Okay? Now, let's talk about something that would have a secured bond. Companies like Lyft, even Uber, those are new companies. They don't have well-established track records. They're pretty new in the business. Some of them may not even be making money yet. Now, if you're going to lend money to somebody, if they're not really making money, you're going to want to make sure that you get something of value. God forbid they don't pay you. And that's what this is talking about, whether you're talking about secured or unsecured. Okay? So companies like Coca-Cola, Pepsi, those big companies, those old companies, Verizon, those are the types of companies that would get unsecured. There's no reason to think they're not going to pay you. The faith in that company is very high. They've been around for years, so they're not about to try to default on their bond payments. Whereas things like Uber and Lyft, they're pretty new companies, and they may have a hard time paying their bills. So instead of just giving them money and hope they pay you back, you're going to say, well, I'm going to put a lien on something of value. So that's what we're talking about when we talk about secured versus unsecured. Now, at this point in time, I'm going to stop this video and I'm going to send it to the cloud for you. And then I'm going to start the second video for this week. Now, what I do want you to do is we're going to start the second video at slide number 6. This is where I need you guys to start paying close attention and listening and paying attention to what I'm reading, slide by slide. So please, 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 when we get to the second video, please make sure that you have a pen and paper handy. I do want you to start jotting down some notes when it comes to this next part. I will be moving the computer a little bit, but I'll tell you when I'm going to be doing that so that this way you can actually go back to the screen and see what I'm talking about. So bear with me. And again, for those of you that at this point in time, you're listening to me for the second time, for those of you that are feeling overwhelmed, do not feel overwhelmed, please. Okay? We're just getting started. We will take care of everything. We will get through this. So don't go jumping off the ship. Don't throw the baby out with the bathwater. Whatever acronym or pseudonym you want to go with, just take your time. These videos are able to be played over and over and over and over again. So you're able to do this work at your leisure pretty much. So don't hesitate to re-listen to a lecture. Don't be afraid to ask some questions. So I'm going to go ahead and close this video out with that. And I'll be right back with our second part of our lecture for today.